The day confidence quietly cracked. It didn't arrive with fear or panic. It arrived as a pause that lingered a second too long. In that pause, something essential slipped away, unnoticed by almost everyone watching. To understand why this moment matters today, we need to step back to a time when confidence felt justified. Markets were orderly. Volatility behaved. Participants trusted not just the data, but each other's reactions to it. Prices moved because everyone believed someone else would respond predictably. That shared belief was the glue holding the system together. Confidence in markets isn't optimism, it's coordination. It's the assumption that when something happens, others will act in familiar ways. For years, that assumption held. Small shocks were absorbed, dips were bought. Uncertainty resolved quickly because conviction filled the gaps. The first reveal begins with behavior that seemed harmless. Buyers still showed up, but later than usual. Sellers still tested levels, but more cautiously. Trades cleared, but with less urgency. Nothing broke. Nothing failed. Yet each interaction carried a subtle question that hadn't been there before. The second reveal came through repetition. The same hesitation appeared day after day. Minor events took longer to resolve. Recoveries felt mechanical rather than confident. Participants stopped acting instinctively and started waiting for confirmation. Confidence didn't vanish. It thinned. The third reveal emerged when experienced traders noticed something unsettling. The market was still functioning, but it felt different. Support existed, but it no longer felt guaranteed. Liquidity appeared, but conditionally. The system still moved forward, but without the invisible force that once propelled it. That was the day confidence quietly cracked. Not because of bad news, not because of fear, but because belief in predictable response was replaced by caution. And once that belief changes, markets don't reverse immediately. They drift. What followed wouldn't look dramatic at first. Prices would continue. Headlines would stay calm. But beneath the surface, the market had crossed a line it didn't know existed. The moment confidence stops being automatic, every decision becomes heavier, and every pause becomes a signal. That quiet shift was the beginning of everything that came next. After that pause, the market didn't fall apart. It adjusted, and that adjustment was subtle enough to be mistaken for maturity. Movements became smoother, slower, more deliberate. Commentators praised discipline. Analysts spoke of balance. To most observers, the system looked healthier than ever. But beneath that surface calm, the coordination that once powered confidence was weakening. The conflict emerged in how participants reacted to uncertainty. When new information arrived, responses diverged. Some moved quickly, others waited. A few stepped aside entirely. What had once been a synchronized reaction fragmented into individual judgment. And individual judgment, when shared assumptions disappear, creates hesitation. Liquidity began behaving differently. It was still present, but it required persuasion. Buyers wanted confirmation before committing. Sellers wanted proof before pressing. Depth appeared in flashes, then withdrew. The market could still function, but only as long as nothing demanded urgency. The tension deepened as this behavior repeated. Each small test reinforced the same outcome. Prices would dip, hover, and recover unevenly. No panic, no conviction either. The absence of strong reaction became the new normal, and norms, once established, shape future behavior more powerfully than any single event. Institutional desks felt the shift through execution metrics. Trades took longer to complete. Slippage increased slightly but persistently. Strategies that depended on fast resolution began underperforming. Not because they were wrong, but because the environment had changed. Speed no longer guaranteed advantage. Patience did. Derivatives markets echoed the same message. Protection grew marginally more expensive without visible fear. Skew adjusted not for disaster, but for hesitation. Traders weren't betting on collapse. They were hedging uncertainty about participation itself. The build-up continued quietly. Confidence wasn't breaking, it was leaking. And leaks are dangerous because they don't trigger alarms. They simply drain strength over time. Each calm session convinced observers that nothing was wrong. Yet each calm session also allowed conviction to thin further. Experienced participants began adjusting without saying why. Time horizons shortened. Exposure became more flexible. Decisions were made with exit in mind, not continuation. The market still looked supported, but that support now rested on habit, not belief. That distinction mattered more than any headline, because markets supported by habit don't resist pressure. They yield to it. The quiet crack in confidence hadn't caused a reversal yet, but it had changed the rules under which the next test would be faced. And when that test arrived, the market would respond not with fear, but with uncertainty that had already been rehearsed day after day in silence. The next test didn't announce itself as a turning point. It arrived disguised as routine, a modest data release, a familiar policy update, nothing outside expectations. In another time, the market would have absorbed it effortlessly. This time, the reaction lingered. Prices moved, then stalled. Buyers appeared, but cautiously. Sellers waited, watching for confirmation. The usual rhythm, dip, response, recovery, fell out of sync. What should have resolved in minutes stretched into hours. And in that stretched moment, something became visible that charts couldn't capture. The conflict intensified as hesitation fed on itself. When buyers hesitated, sellers pressed slightly more. When sellers pressed, buyers hesitated further. No one panicked, but no one committed either. The market wasn't afraid. It was unsure whether others would act. Liquidity thinned exactly where confidence once concentrated. Depth was still there, but it fragmented. Orders were smaller. Timing was staggered. The market began behaving like a crowd, waiting for someone else to move first. And when everyone waits, even small pressure feels heavier. Institutional systems reacted mechanically. Risk controls adjusted exposure. Algorithms reduced aggressiveness, not because of danger, but because signals conflicted. The system began protecting itself from uncertainty rather than expressing confidence. That shift mattered. The buildup accelerated as correlations tightened. Assets that normally offset each other began moving together, not dramatically, but persistently. Diversification weakened quietly. Strategies designed to smooth returns now amplified hesitation. The market's internal balance started leaning without anyone pushing it. Veteran traders recognized the feeling. This wasn't a breakdown. It was pre-breakdown. The stage where nothing looks wrong, yet everything feels heavier. Where reactions lag just enough to matter. Where the market reveals it no longer trusts its own reflexes. As days passed, each minor disturbance reinforced the same lesson. Support still existed, but it arrived late. Recovery still happened, but it felt forced. The market wasn't losing ground quickly. It was losing responsiveness. That loss of responsiveness was the real danger, because markets don't need fear to fall. They need hesitation, and hesitation, once embedded, transforms every small event into a test of confidence the system no longer passes automatically. The quiet crack had now widened into something structural. The market was still standing, but it was standing without conviction. And the moment it was forced to choose, act decisively or step aside, the answer would no longer depend on news. It would depend on how much belief had already drained away. The choice arrived quietly, exactly as everything else had. No shock, no dramatic headline, just a moment when the market needed conviction and discovered it no longer had enough. A larger move began, not because fear exploded, but because hesitation finally reached its limit. Sellers pressed a little harder. Buyers waited a little longer. That imbalance, once small, widened quickly. Prices slipped faster than expected, not from panic, but from absence. The support everyone assumed would appear simply didn't arrive in time. That was the climax. Not a crash, a realization. The market had been strong, and then suddenly weak. It had been fragile for weeks, held together by habit and routine. The quiet crack in confidence had been widening beneath the surface, invisible to charts and commentary. When pressure finally demanded a response, the system answered with delay instead of decisiveness. Volatility rose, but unevenly. Liquidity returned in bursts, then vanished again. Correlations tightened as strategies reacted together. What followed looked chaotic to outsiders, but to those paying attention, it was logical. A market without shared belief cannot move smoothly under stress. As the dust settled, explanations flooded in. Some blamed data, others blamed policy, a few blamed sentiment. But none of those explanations reached the core truth. The turning point hadn't been an event, it had been a withdrawal. The slow erosion of confidence that made every later move inevitable. The resolution came not with recovery, but with clarity. Markets don't fail when people are wrong. They fail when people stop believing others will act. Confidence isn't about optimism. It's about trust and response. And once that trust cracks, even good news struggles to hold weight. In the weeks that followed, behavior changed. Participants became selective. Time horizons shortened. Liquidity was offered carefully, not freely. The market stabilized, but on different terms. Less fluid, more cautious, forever altered by a moment most never noticed. The hidden lesson was simple and uncomfortable. The most important shifts in markets happen when nothing seems to happen at all. Because by the time confidence breaks loudly, it has already broken quietly. Subscribe to join the journey. The day